Welcome to Explain the Charts, where today we are analyzing the GBPUSD pair on May 1st, 2026. The fundamental news landscape for the British pound has been dominated by several key factors over the past week. Traders are currently weighing the U.S. Personal Consumption Expenditures Price Index, which is providing meaningful impetus to the pair. Additionally, the U.S. Federal Reserve's hawkish tilt has been acting as a tailwind for the U.S. dollar, often capping the upside for cable. Global geopolitical tensions, specifically the U.S.-Iran stalemate, continue to influence risk appetite and dollar strength. Recent headlines indicate that the British pound had softened following Bank of England decisions, but the charts are starting to tell a different story. Analysts have noted that GBPUSD recently recorded strong consecutive gains, successfully breaking above a stubborn resistance level at 1.3480. This fundamental backdrop sets the stage for our deep dive into the historical and real-time price action data. Looking at the daily chart for GBPUSD, we can see a clear uptrend that began in early 2025. The pair moved from lows near 1.22 in January of last year to a significant peak of 1.3868 in late January 2026. This massive rally showed the resilience of the pound despite the hawkish rhetoric from the Fed. However, February and March of 2026 saw a period of cooling off as the pair retraced back toward the 1.32 level. We can observe a consolidation pattern during March where the price oscillated between 1.31 and 1.34. This period of uncertainty was likely due to the market waiting for fresh signals regarding global inflation and interest rate paths. In early April, the price dipped briefly to 1.317 on the 13th, but buyers stepped in aggressively to defend that level. Since then, we have seen a series of higher lows on the daily chart, which is a traditionally bullish signal. Zooming in on the month of April 2026, the recovery becomes much more visible. On April 7th, there was a sharp drop to 1.27, but it was followed by an immediate reversal, creating a strong long-term support wick. The price then climbed steadily, breaking back above the 1.33 handle by April 20th. Notice the candle on April 28th, which showed a minor pullback but closed above 1.352. The most significant move in this recent window occurred just yesterday, April 30th. The daily candle opened at 1.3488 and rallied to close at 1.3601, effectively breaching that stubborn 1.3480 resistance mentioned in the news. This breakout was accompanied by a transaction volume of over 308,000, the highest we have seen in weeks. High volume on a breakout usually confirms that the move has institutional backing rather than being a retail trap. If we switch to the 1-hour chart to look at the intraday rhythm, we can see the momentum building during the London and New York sessions. On April 13th, the price hovered around 1.34 before finding a base. Between April 14th and 15th, there was a very consistent laddering effect where each hourly candle pushed higher. We see a cluster of high-activity peaks during the 1400 hours and 1500 hours Universal Time Coordinated Hours, which aligns with the New York Open. The volatility during these hours suggests that U.S. economic data releases were the primary drivers for the moves. The 1-hour chart shows that every time the price touched the 1.355 level, it was met with quick buying pressure. This indicates that former resistance was flipping into support during the middle of the month. The relative strength of the pound during this period was surprising given the hawkish Fed tilt we discussed earlier. Moving to the 15-minute chart, we can examine the mechanics of the April 30th breakout in even greater detail. The market showed very low volatility during the early Asian session on the 29th and 30th. However, as we hit the 1400 hours Universal Time Coordinated mark on April 30th, the volume surged and the price began to escalate rapidly. In just a few hours, the pair moved from 1.352 to 1.360, clearing multiple smaller resistance levels. The closing 15-minute candles of the day on April 30th showed the price stabilizing near the high of the move. It is important to note that the price did not see a significant sell-off after the spike, which shows strong holding power by the bulls. This tight consolidation at the top of a big move often precedes a secondary continuation rally. Short-term traders should look for the 1.3600 level to be tested as support in the coming hours. To recap the key levels, our primary support has now moved up to the 1.3480 to 1.3500 zone. As long as GBPUSD stays above 1.3480, the technical bias remains firmly bullish in the short term. To the upside, the next major hurdle is the early 2026 high of 1.3860. If we see a daily close above 1.3650, the likelihood of a run toward 1.38 increases to about 70%. Conversely, if the US-Iran stalemate results in a significant flight to safety, we could see a rapid reversal back to 1.33. The bullish case is supported by the massive volume on yesterday's breakout and the failure of the dollar to maintain its peak strength. The bearish case would require a breakdown below 1.3450, which would signal a fakeout and a potential return to the March range. Keep a close eye on upcoming employment data from both the UK and the US, as these will be the next catalysts. Trading the news requires patience, so wait for retests of these key levels before committing to a direction. This concludes our analysis of GBPUSD for May 1, 2026. Please remember that this is not financial advice, and you should always do your own research before making investment decisions. Thank you for watching Explain the Charts, and we will see you in the next analysis.